The Elliott Wave Theory is a widely recognized principle in technical analysis that has intrigued many students of the subject. However, despite its popularity, it is commonly observed that the theory is often misused and misinterpreted in forums, blogs, and other media, leading to a lack of understanding of its proper application. While the theory presents a set of simple rules, the real-time application in live markets can be challenging, causing some to label it as too subjective. Nonetheless, for those who have a clear grasp of the rules, the Elliott Wave Theory can serve as a dependable method for interpreting and forecasting market movements. On the other hand, for those who fail to fully comprehend the rules, the resulting incorrect predictions can lead to the dismissal of the theory as unreliable. Despite these challenges, many traders have found success in using the Elliott Wave Theory to pinpoint key turning points in the market. In this video course, we will delve into the fundamental principles of the Elliott Wave Theory, with a focus on proper interpretation and application. Through a series of lessons and examples, we will gain a clear understanding of how to correctly use the theory to analyze and forecast market movements. By the end of the course, you will have a solid foundation in the Elliott Wave Theory and the ability to apply it confidently in your own analysis. The Elliott Wave Theory, developed by Ralph Nelson Elliott in the 1930s, is a widely used analytical strategy for forecasting market movements. Originally created to predict stock prices, the theory has since been applied to a variety of markets, including foreign exchange. Today, it is a popular approach among technicians of leading investment banks and other market participants. The basic principle of the Elliott Wave Theory is that markets are not completely efficient and that changes in prices are not random, but rather a reflection of shifts in investor behavior. By understanding mass psychology, it is possible to predict these changes and use them to forecast market movements. The theory is founded on the idea that prices move in predictable patterns, known as waves, which can be identified and analyzed to make predictions about future market trends. In order to effectively use the Elliott Wave Theory, it is important to understand how to identify and count the waves that make up market movements. The theory is based on the idea that prices move in predictable patterns, known as waves, which can be divided into two types: motive waves, which move in the direction of the underlying trend, and corrective waves, which move against the underlying trend. The most basic wave structure consists of 5 motive waves, which define the direction of the near-term trend, followed by 3 corrective waves. This structure is known as the 5-3 pattern. It is important to note that within this pattern, there may be smaller waves that form, which will be discussed in greater detail later in this video. It is also important to remember the principle that every action creates an opposite reaction, which applies to the waves within the theory. Applying this thought to the Elliott wave, we can understand the market movements as a sequence of wave structures, where each wave follows the previous one. To fully grasp the Elliott Wave Theory, it is essential to understand the psychological factors that drive each wave, as the zigzag movement of prices reflects the alternating optimism and pessimism of market participants. In an uptrending market, the 5-wave pattern can be broken down as follows. Wave 1, impulsive, minor up wave in major bull move. In Wave 1, prices rise as a relatively small number of market participants buy a currency pair for either fundamental or technical reasons, pushing prices higher. Wave 2, corrective, minor down wave in major bull move. After a significant run-up, investors may get fundamental or technical signals indicating that the currency is overbought. At such time, Wave 2 develops when original buyers decide to take profits while newcomers initiate short positions. Price action reverses, but generally does not retrace beyond its initial low that attracted buyers at Wave 1. Wave 3, impulsive, minor up wave in major bull move, often the longest wave of the 5. Wave 3 represents a sustained rally, as a larger number of investors use the Wave 2 dip as a buying opportunity. With a broader range of buyers, the security enjoys a stronger push higher, with prices extending beyond the top formed at Wave 1. Wave 4, corrective, minor down wave in major bull move. By Wave 4, buyers begin to become exhausted and again take profits in reaction to overbought signals. Generally, there is still a fair amount of buyers, so the retracement here is relatively shallow. Wave 5, impulsive, minor up wave and major bull move. Wave 5 represents the final move up in the sequence. At this point, buyers as a whole are motivated more by greed than any fundamental justifications to buy, and bid prices higher irrationally. Prices make a high for the move before a correction or reversal ensues. The high in Wave 5 often coincides with a divergence in the relative strength index. The Elliott Wave Theory also includes 3 additional waves known as the A, B and C waves, which are used to identify changes in market trends. These waves are as follows. Wave A, correction to rally. Initially, Wave A may appear to be a correction to the normal rally. However, if it breaks down into 5 subwaves, it indicates that a new market trend may have developed. Wave B, bear market correction. Wave B tends to provide an opportunity for bears to sell as others take profit on their short trades or exit their long positions. Wave C, confirms end of rally. Wave C is the last wave of the cycle. At this point, Wave 3 typically breaks key support zones and most technical studies confirm that the rally has ended. The Elliott Wave Theory includes specific rules for counting waves in order to correctly identify the patterns that make up market movements. These rules are the foundation of the theory and are important to understand for accurate analysis. The 3 main rules for counting waves are: Rule 1. Wave 2 cannot retrace more than 100% of Wave 1. This means that the second wave in the pattern should not go back further than the starting point of the first wave. A violation of this rule is considered a strong indication that the pattern being analyzed is not an Elliott wave. Of waves 1, 3, and 5, wave 3 can never be the shortest wave, it is, often the longest. This means that the third wave in the pattern should be the longest of the 5 waves. A violation of this rule is also considered a strong indication that the pattern being analyzed is not an Elliott wave. Rule 3. In an impulse, wave 4 cannot overlap wave 1. This means that the fourth wave in the pattern should not extend beyond the ending point of the first wave. A violation of this rule is also considered a strong indication that the pattern being analyzed is not an Elliott wave. Corrective waves guidelines. Alternating waves tend to have equality or Fibonacci relationships to their distances. For example, wave C equals wave A. Or wave C equals 0.618 of wave A. In a complex correction, the distance of wave Y tends to have an equality or Fibonacci relationship to the distance of wave W. Corrections to a completed impulse wave tend to retrace back to the previous fourth wave of that impulse. Elliott wave theory can be difficult to understand because waves frequently occur at many different levels or at different degrees of trend. In other words, there are minor waves within larger waves. That is why at many points in time, multiple correct wave interpretations usually exist. A good Elliott wave technician will use deductive reasoning to figure out which combinations of patterns are not feasible and eliminate those. Then, of the remaining patterns, determine which wave counts are higher probability. The major waves determine the direction of the trend, while the minor waves help to form the major waves. Used in conjunction, traders can apply Fibonacci ratios and guidelines to Elliott wave theory to help determine when markets will reach a top or bottom. It can also be used as a tool to identify points to trade within the trend or to participate in the shorter minor wave cycles. It is important for Elliott wave traders to be aware of both the minor and the major waves that may exist. The following is an example of a minor wave appearing within the larger waves. Since many different waves can exist during the same time frame, that increases the risk of forecasting error, traders should follow certain guidelines to minimize risk. The most important of which is to follow the principle that the trend is your friend. This means that it is more prudent to only look for opportunities to sell into minor waves when the major wave is a downtrend, and to buy when the major wave is an uptrend. More rules can be used though to determine levels for placing stop-loss orders or to exit the trade. Fibonacci ratios are one of the most useful ways of identifying possible peak or bottoms of wave cycles. A popular relationship that exists is that wave 2 retraces 50% or 61% of wave 1. Let's look at an example for this retracement. As we can see from the image, wave 2 retraced 61% of wave 1. Also, this is a very good example of applying the rules that we've discussed. Wave 3 is the longest and, as we can see, the fourth corrective wave didn't overlap wave 1's top. This concludes this Elliott Wave beginner course. You can find the advanced Elliott Wave course link in the description of this video, or as a recommended video at the end screen. If you enjoyed this presentation, don't forget to like this video and also subscribe to my channel for more trading education content. Have a nice day.